She is among the most well-respected bank analysts on the street and a Bloomberg best, Morgan Stanley's Betsy Graseck, here on the Inside Track. Betsy, nice to see you.
Thank you, Eric.
So, as I just mentioned, you have identified Europe as perhaps the #1 risk to large cap, or investors anyway, in large cap U.S. bank stocks. The Eurozone recession is a possibility. The analysts at Morgan Stanley are expecting one. Deleveraging by EU banks. Is that risk fully priced in to U.S. large cap financial stocks right now?
You know, as it looks today, I would say the answer is that it looks very much priced in, 100%, who knows, but it looks like it's largely priced in. What I would say, however, is that there's some opportunities and still some risks. The opportunities are on taking some share from European competitors as they delever, as they reduce their exposure not only in some of the markets in Europe, but more importantly in some of the non-European markets. So, for example, in the U.S. And then some of the risks are as how deleveraging impacts global growth. One would expect that it would be a little bit of a drag on global growth.
Let's take one bank as an example, Bank of America. Should this bank be trading under $5? Is it Europe? Is it something else? I mean, if the risk of Europe is fully priced in, what on earth else could be dragging B of A sub $5?
So, very interesting question, important question. And the way we think about valuing Bank of America and all the bank stocks we look at is on a bull-bear base case continuum. And, you know, look, our price target right now today is about $7 for B of A. So we would say that it's not trading in line with what our 12-month forward expectations are. What could be dragging it down below what we think fair value is? A number of things. One could be the European question. One could be some of what's going on with the mortgage litigation. Another could be the settlement with the state AGs. Will it, won't it? You know, this back and forth. I think really the nut of B of A and the issue for B of A is the uncertainty. Clearing up the uncertainty should reduce some of the pressures on the stock.
There's less uncertainty around another big bank, the only bigger bank in America, JP Morgan. You're overweighting JP Morgan, even though we heard from Jess Staley yesterday that the bank is increasing its exposure to Europe. I want you to listen to the comments he made here on the Inside Track.
We can stay engaged with our clients in Italy and Spain and across Europe. So we do it with prudence. We do it in a way that's not going to threaten in any shape or form the strength and the resiliency of JP Morgan. But that size lets us stay engaged with our clients, and that's what we're doing.
So he says, Jess Staley, the CEO of JP Morgan's investment bank, says size is an advantage for JP Morgan over there, that they can afford to stay committed, maybe sustain a few losses. Two things. Do they make sense? On the one hand, increasing exposure to Europe right now, and on the other hand, rating JP Morgan an overweight when Europe is the biggest risk to the large cap banks.
Sure. So on the question of does it make sense for JPM to increase their exposure to Europe, you know, from where I sit, I would say the answer is yes, given the fact that you're not talking about broad Europe, every single, you know, person, country, et cetera. You know, my expectation is that you're talking about key clients, key customers. And when you look at corporates, when you look at high net worth customers, you're actually seeing balance sheets that are pretty strong, not necessarily just in Europe, but across the world. And so, I don't know, I wasn't there. I'm not in his head, but that's, you know, how I would respond to your question.
Yep.
And then as it relates to why we're overweight JPM, you know, the way that we're thinking about our overweight stocks right now, three key things that we're looking for. One is who can take some share from Europe, either onshore in the U.S. as they reduce their exposures, you know, or in the European theater. Second is who has the ability to have rising, more sustainable EPS, and JPM, frankly, is among the largest cap banks I cover, one of the ones with the least amount of earnings volatility. And then third is a high and growing dividend yield. And so JPM does fit into all those things. In addition, I wanted to keep some beta in the overweights.
All right, Betsy, great to see you here, and please come back soon. Betsy Graseck of Morgan Stanley talking to us about America's biggest banks. You just heard it, Bank of America, JP Morgan. It's a tale of two stocks, really, and a pretty good explanation as to why.